Hey everybody, Dan Rawitz here. This is video number 3 for Intro to Options Trading, and I wanted to take a couple of minutes to show you how I evaluate a trade. I don't know if I'm going to take this trade or not, but I wanted you to see the steps that I take to make the decision. So this symbol is DE. It's actually John Deere Company, and John Deere Company showed up on a report that I subscribe to, which shows stocks that have a huge increase of implied volatility. That probably doesn't make sense to you right now, but what I will tell you is when we sell, whether it's a put or a call, which remember, I'm always a net seller because I like to get paid up front, higher volatility stocks are going to make you money. Low volatility stocks, you want to be a buyer. So John Deere showed up as a implied volatility that really jumped a lot. And I suppose it's happened for a lot of reasons, but one reason is it went up $4 alone today. So between the price and the volatility movement, you would start thinking that maybe something's up here. The next thing I want to decide is where do I feel safe owning this thing? And so I want to find out where's the support. So for me, and if you follow me on Rate Watch for a while, you know what support looks like. And I would say we have incredibly strong support at 134, 135. And then we've got secondary support down here around 130. And we haven't been below 130 since October of 2017. So that's all very favorable. Okay, what I don't like is that we've got a trend line that is moving down, although we tried to break that trend line today, so that's pretty favorable. But again, this thing is flattened out now. I believe that we are now moving into a range, and I believe we're moving out of this trend line. The next thing that I look at is the stochastics. Let's go with the RSI, and we'll make that red, I guess. And what this shows you is typically over 80 is overbought and below 20 is oversold. And it looks like, the stock is somewhat overbought, and I believe that was just from today because they had pretty big trading volume. And a lot of people jumped in. It'll be interesting tomorrow to see what the stochastic does. I'm not going to put an order in until the morning, until I can watch the stochastic one more time. But if I can sell a put option, meaning I'm going to get paid the second I take the trade, and the stock's going to have to stay, I prefer above 130 or 135. 130, I like that secondary safety. So now I'm going to go in and see what the market's paying me if I want to sell a put contract for 130. What that means, as long as the stock stays above 130 between now and the end of the contract, we make some money. So let's see what the market's paying right now. Okay, so I said 130 and 135. I have a couple choices. I could take trades now that expire on Friday, but you got to take big risk when you take these short-term trades because you've got to take them at higher prices. So I'm going to look at the August 10th. August 10th is about a week before they report earnings. I don't like what's happened the last 2 times they've reported earnings. I'll show you that chart again in a second. So if I can get a decent price around 130 or 135 that makes sense, this might be a trade worth taking. So let's see what we get paid at 130. Okay, at 130, it's pretty bleak. The market's paying about 10 cents. And at 135, the market's paying about 25 cents. So if you bought 10 contracts, you'd get paid $250 up front, and then you would hope the stock stayed above. Oh, I'm sorry. The reason it's so cheap, I'm looking at that's actually pretty good. I could buy a 135 contract that expires on Friday. So it's a position we would hold for only 2 days, as long as the stock stayed above 135. That's not actually a bad trade. But I'd rather be a little safer, go out here to August 10th, and go all the way down to 130 and see what the market's paying. So this is nice. At 130, we could get paid about 53 cents. So 10 contracts, we get paid $530. And I'd probably put a stop loss in here at about 25 cents. So the worst case is I'd lose $250, but I'd make $500. I always go for a 2 or 4 to 1 deal. If I want to take a little more risk at 135, you get paid $1.38. But you can see the market's thinking like I do, take a little less risk and go down here. So this is a trade I might like to take because I don't think the stock's going to fall below 130. I could be ultra conservative and go down to 125 and get paid 22 cents. Not a bad idea. I do that a lot. Sometimes $220 is better than nothing for sure. And this stock going down to 125 is not very likely. The last thing we could look at is to see what happens if we go out to August 27th. Now again, we won't hold these that long. We're going to hold these until we start seeing 50 to 60% of our profits. But the farther out you go, the more you get paid. So let's see if we took this 130 trade we were talking about expiring August 10th, that we're going to pay us, what, 50 cents? Now we can get $1.36. Why? Because we're taking a little more risk by going a little farther. That said, now I could go all the way down to 125 and still get paid 65 cents. Love that trade. This is a smart trade. Go back to the chart and you can help me decide whether you think this thing is going to go below 125, because I think that that's a good trade to take. So here's the chart again. Let's just look at 12 months. I think going back 2 years is almost irrelevant. I mean, that's just so much time. Okay, so this is a 2018, a little bit more. It's going back from September. Okay, so in September it touched 115, but it's been above 125 since October. So it's been almost a year. Yeah, it's been almost a year. What is that, 9 months since this stock has touched 125. I think the option to buy this thing at 125 is pretty safe bet of you getting paid. And I think this is a great level. So let's stay tuned tomorrow. We'll see if we take this trade or not. I'll sign off for now. I hope this wasn't too confusing. That's it. Thanks. Bye.